Welcome back, everyone. Nick here. This is the fourth installment of our options series, and this is about spreads. It's not going to be a delve into each particular one. It's like a blanket statement on all of them to define them, visualize them, to help people wrap their heads around them. I encourage you to watch the first installment, which was describing options in general, the second one, which was about call options, and the put options, and the third one was about call options. This is about spreads. So far I showed you how to buy a put. And essentially I would take a put and say buy it, pay the cost, and that's it. So if the price rallies, this put is going to get demolished really quickly. How do I mitigate risk? Instead of buying a naked put, that's called a naked put, one leg, I would do a spread. So I would buy one and sell one. And in this case, if I bought 120, I would spend $4, and then I sell the 230. The 115, I collect 230. I'm going to round 4 and 2. So in this case, ignore this price. It's erroneous. I don't know what's going on with this platform. This is E-Trade. So in this case, the outlay is now smaller. So that's the first way I mitigated risk. I'm spending $2 instead of $4. In return, I capped my maximum winnings, because if price goes to 115 or below, this value of the spread I took should be 5 at expiration. $5 wide. I only paid 2, therefore my upside is 3, but I limited my upside. Had I not sold this, I'm making money for as long as the price is falling. So, but this is the, give take. I take a little bit of comfort, I give back a little bit of potential upside. But what's wrong with more than doubling your money? Nothing. Absolutely nothing. So there's no shame in it. More importantly, on bad days where on good days if the stock rallies, on the day where the stock rallies, how about that? That's better. On the day if the stock rallies after me buying this, if I had bought the naked leg, that $4 would turn into $2 in a blink. In this case, if I did a spread, I won't lose as fast, because it's literally spread. I'm buying one, that's going to lose money. I sold one, that's going to make money. The net effect will be a lot less damage than had I just bought one and that's it. So this is a debit put spread. Debit, because it's the net effect is money out of my pocket. 4 minus 2, put, and a spread. Spread, debit put spread. It's directional, and it is bearish in nature. And it is called a vertical spread because it goes up and down in the same time frame. So let's put this on a chart. This is Apple. And in this case, I just showed you I would buy the 120 put for May. I would sell the 115 put for May also. So that would be a calendar. Actually, the 115 is right here somewhere. So this is called a debit put spread vertical. Vertical, it's up and down May. There are variations to that. Okay, the variation is, the first easy one is a calendar spread. All right, so instead of buying this one and selling that one, I would still buy this one, and I would sell April 120. Why would I want to do that? This is specific to somebody who's bearish Apple, but not necessarily now. They think, it's going to lollygag for a couple of weeks and then whoosh, drop. Then this works really well because they bought one and they sold one. And the one they sold will expire before the drop comes. That's the idea. If so, then they're left naked, the long put, and the profits will be unlimited. So this lowers the entry cost, but that then requires like some good mojo with timing. Let me show you that visually on the chart. So this is the vertical spread that we just looked at. Bought the 120, right here we're looking now, and sold the 115. What if I did what I just showed you on the picture and sold the, excuse me, frog in my throat, new mouse, I can't control it, and sold the April 120. Whoa, where did the leg go? Well, remember, it's April, so I've got the 120 showing. Let's go look at the April. Boom, there it is. John Madden, boom, there it is. So buying this, still the same one. I have not moved it. I just added to show this contract, April, and selling the 120. So the net effect now, I'm spending $4 per contract. I'm collecting $1.20, not $2.30. Wait, why, Nick? Why is it more less? Even though it's higher, that's because there's a lot less time. It's 14 days on this contract I'm selling. So, what ideally want to happen is Apple meander lower, hit 120, but not until the 14 days expire. This way, whoever bought this from me lost their money, and that money is in my bank already banked, leaving me long this leg, to which now I really paid less than $3, $2.80, because that died in my favor. So now that really cost to enter was not 4, was 4 minus 120, right? So that's a calendar put spread. Calendar because I played with the calendar. I bought one in one time frame, I sold one in another time frame. There are many variations to that one. So one of them, you've heard the term maybe, maybe not. We'll go back to the pictures. So this is vertical. I'm rewinding. Calendar. That's what we just saw. Calendar spread. Vertical spread. Is there another version of this? Yep. So buy the same one, May 120. Sell a put lower in April than the one I bought in May. What? Yep. That's called a diagonal. Check it out. It goes diagonally. So calendar, diagonal. It's basically a calendar. I'm going to leave it as is. But instead of selling the 120, I choose to sell the 119. So now I bought the 120 for $4. Same. I did not sell the 120 in April. I sold the 119 in April for $1, 20 cents more, less, or 30 cents less. Why would I want to do that? Well, this one has a big disadvantage. Remember I told you how beautiful it was if I timed it right? Well, what if I don't time it right? What if Apple falls really hard through 120 way before the 14 days, or just at the 14 days? Then I'm screwed, because I'm long and short at the same level, and I paid a premium to be there. So long and short at the same level, there's no money to be made. And having paid for it, that means I'm going to have to manage out of a little loss. Sometimes if there's time on the clock, this can work, but in reality, it complicates matters if the price just falls. How can I fix that? I can do the diagonal. Why would that change matters? Because I'm buying at 120 still. I am selling at 119. That caps my profits. So at least now I have a differential of $1. This helps me manage my problem better. So what if I do it here? Way better. Okay, I collected a lot less. But the scenario where if Apple goes whoosh down, now it becomes profitable and a lot easier to manage. Again, this is still called a diagonal. So let's review pictures. First one, vertical spread. Second one, calendar spread. Third one, diagonal spread, which is basically a calendar offset. Can I sell it up here? Sure, but that opens a whole can of worms. It becomes a credit. So opens credit risk, I should say. Different conversation. For now, this is the vertical debit put spread, calendar debit put spread, and also a diagonal debit put spread. They're all debits, money out of my pockets, different kinds. Does this work on calls as well? Absolutely. So if I buy the 125 call in May and I sell the 130 call in May, what do you think is that called? I'll give you a minute. That's called vertical. What else is it called? Debit call spread. I'll show you a visual. All right, so now we talked about the put side. We're going to flip to the call side, and we're going to flip these to call. I'm going to start from scratch so you see it how it happens. So I'm going to buy the 125 call. That's naked, all risk, all reward, right here, right now, fast trade. I'm tempering it a little bit. I'm collecting $260 on top of spending $4.40. So the net effect, I can't do math now. So I'm going to say $2. So I'm paying $2 for a $5 white spread. Similar situation to the other one. Again, ignore these numbers. So I have limited profits, but it's more than double because it can be $5 wide. If Apple rallies to 130 or higher in the time allotted, then this at the expiration, this should be $5. So I, in theory, can take $2, turn it into $3 extra, so $5 total. That's nice profit. And it also loses slower. Of course, it gains slower, and its maximum gains are set. This is the debit call spread. It is also directional. The debit put spread needed a price drop. This one needs a price rally. So it's a bullish position in theory. And the visual to it was this. I buy one for $4.40. I sell one for, and the difference is $2, and the upside potential is $3. So that is a debit call spread, debit put spread. So I can do a calendar with that one as well. I can go and I will buy this, and instead of selling that, I would sell April's 125. So let's see if there are any. Are we buying the 125? Okay, so I need to go up. Good Lord. I'm trying to put it into visual range. Okay, there we go. So we go to April. Nope, went the wrong way. Sorry, this one goes to April. It's long day already, long week. There we go. All right. So I'm buying the same one in May. I'm showing you that instead of selling the 130 call in May above it, I would, here, let's roll down. Instead of selling this 266, I'll sell this one, the call in April. So again, this is about timing. If I'm good, if I think Apple is going to spike, but not for 14 days, this is the way to go, because I'm spending $4.40. I'm collecting $1.50. The difference now is a little bit bigger than the other scenario where I'm collecting $2.66. However, this is going to die, hopefully, in 14 days and go off the books, leaving me naked long one leg and having lowered my entry cost by $1.40. So if it does spike with my perfect timing, then I stand to make unlimited and fast versus being limited with the vertical call spread that we had earlier. So that is calendar. So third version of it is the diagonal, and it would go like this. So just like the problem with the debit put spread or the calendar put spread, this is also a problem. Why? What if Apple spikes in the next few days? Then I'm going to have to manage a little loss because I'm long and short at 125, and I paid to be there. So it's not ideal. How do I improve my odds and make it easier? I don't sell the 125 like the one I bought. I give myself some breathing room. Which way do I go? I'm going to give you a second to guess. Down or up? No, up. Why? Because I want to be short higher. I want to stop myself out higher. So I'm in at 125. I'm out at 127 or 126. Now I collect less. But I have better odds. If Apple spikes the next minute, at least I can manage some profit. Easier to manage. So that's also a debit, and it's also a call spread, but it's called a diagonal, and the visual of it is right here. Diagonal. Okay, so we just looked at 6 ways to describe a vertical diagonal calendar. So these are 3 different kinds. There are literally hundreds. You've heard of a butterfly. I'm not going to go through it because it needs its own video. So I shy away from butterfly spreads because they're a pinpoint. Like if I know that Apple's going to 132, I can structure a trade that costs pennies and would yield like $9. So that's a lot of money in options terms, because each one is, so $9 is 900 per contract. So it's like a 10 to 1, sometimes 12 to 1 or 8 to 1, depends on the structure. But it requires you to, pin it. It's like in roulette terms, go back to casinos. You get paid a lot for picking one number, right? If you say, I want this 14 white or red, I don't know the table on the roulette. And if I get that, I get paid 35 extra times my money. So that's a lot of money. But what are the odds of me pinning that number? Low. Same with the butterflies. They do have their uses, but you need to be good at it or super lucky. There are iron condors, which are four-legged spreads, and sounds funny to say it, but those are their own videos. So now we talked about debit spreads, vertical spreads, debit put spread, debit call spread. There are also credit spreads, because if I'm buying a spread, somebody's selling them the spread on the other side. So there's somebody taking the exact opposite situation as me. So that's its own segment. I will do another video on just selling spreads. Completely different strategy for me. Debit spreads, I want to be close to current price as possible. And by the way, here's a little tidbit. So if I'm buying a debit spread, if I think Apple is going to rally and I want to buy a 125, 130 debit call spread, why would I want to buy it shorter term? It's going to cost me about the same to buy it shorter term, May, June, July, August, September, or next year. Because if it's close to the current price, the spread will always cost about half the width of it. So if it's a $5 spread, I expect to pay $220 to $260, depends on how the action is going on the price. So it's 50% of the width, which is $5. So why wouldn't I want to buy myself some time? Of course, that would benefit slower. So if I pick the right way, short-term spreads will gain faster than long-term spreads. So that's a drawdown. But depends on the situation. I usually give myself a little bit of time. All right, so this is a miniature introduction to spreads. I don't take spreads I don't understand, and I don't take risk that doesn't make sense to me. I don't open myself up to blow-ups. Therefore, I don't take trades that will break my account. It's okay to break my heart, but not my account. So literally, there are hundreds of other spreads we can do. Back spreads, we mentioned butterflies, iron butterflies, iron condors and regular condors, and all kinds of, what is that, a broken elephant or something like that, broken wings, just a ton. They have funny names for them. I don't particularly subscribe to a lot of them. I tend to find something that works for me and just keep repeating the same process over and over again. All right, so on to the next video.